Wonderful morning looking at many aspects of banking for a better world. And we're now going to move into a session brought to us by the Swift Institute, which is the Ethics and Trust in Finance Prize nominees. So this is a really exciting session where we get to meet the finalists from a very, very important initiative with a number of key strategic partners of Swift and the Swift Institute. I'm going to tell you a little bit about the award before we get on to meet the finalists. So the Ethics and Trust in Finance Prize runs every 2 years to promote greater awareness on the benefits of ethical finance amongst young people throughout the world. It aims to encourage high-quality standards in the management of banking and financial services based on trust and integrity. Since 2006, the competition has prompted a debate about many different aspects of ethics in finance, ranging from the role of compliance officers, the challenges of managing cash ethically, the contribution of microfinance to economic development, and the way rating systems works, to name but a few. Now, in its 7th edition, the global competition for the prize was open to young people aged 35 years or younger from throughout the world. The finalists and winners of the prize have not been announced. The award ceremony will take place in November at the OECD in the presence of the Secretary General, and that's very exciting. We just heard the confirmation of the Secretary General this morning. Now, there's been expressions of interest in the prize from over 60 countries. So this project is really expanding in terms of the number of countries and participants who would like to take part. And at the ceremony in Paris, this document is going to be produced. This is the previous version. You can see here, Finance and the Common Good. There's going to be the 7th edition from 2018 and 2019. It's going to collect together all of the final nominated essays and indeed the winners. So Swift and the Swift Institute, in partnership with Euroclear, are proud to be partners at this 7th edition of the prize. And we are very pleased to be able to welcome 3 of this year's brilliant nominees to Sibos to the spotlight stage to hear their ideas for the future of the industry. If you are inspired by their presentations and you would like to apply for a ticket to join them at the OECD, you can send an email to office@obsfin, OBSFIN. That stands for Observatory de la Finance, obsfin.ch. So office@obsfin.ch. If you didn't get that, come and find me. I'll give you the email address again, and maybe you will be joining our brilliant finalists in Paris. So, ladies and gentlemen, it gives me a great deal of pleasure to introduce the first of our 3 brilliant finalists to the spotlight stage today. He is an accountant from First Accounts, SaaS, and Warp Group. Ladies and gentlemen, please give a very warm spotlight stage welcome to Colin Sweetman.
Thanks, Oisin. Good afternoon, everyone. Thank you for having us. What got me interested in writing about ethics and trust in finance is the desire to become more enlightened and ethical myself, because I had never really given it any thought before. To a large degree, this has worked. During writing, it also occurred to me that if we could apply the same treatment to large corporations and national organizations, we would probably be the first generation to actively think about and challenge how our motives for profit affect others both locally and globally. My favorite moral philosopher, among other things, was Albert Einstein, for having to think about the moral dilemma of endorsing the Manhattan Project to Franklin D. Roosevelt, which followed humanity's first globally felt existential and moral threat through the introduction of atomic weapons. The quote should, if we can go back one slide. The quote was there, but it was the quote I actually prefer to use is fear of retribution and hope of reward. This is considered the bare minimum of acting ethically. Most people have a basic definition of ethics, which is ethics is good. This is very obvious, but acting ethically is proven to make people want to do business with you because it promotes and strengthens trust and confidence in mutual relations. this is the quote I was talking about before. Who decides what is ethical, though? I did a case study, not on the banking sector, so anyone working for a bank can rest easy. I chose to focus on the relatively recent introduction of workplace pensions, for which I think I'm the first to highlight several key issues with. This is the slide. You've got on the left a default fund, and on the right an ethical fund. I'm not going to name the pension provider for this, but my problem is with the scheme itself, enrollment is automatic. If you've ever heard of the default effect, it basically means that making an option the default will increase the probability of it being chosen or sustained. This means that we have a generation of employees now who know that they contribute to a pension fund, but who are largely unaware that they are investors and even more unaware of what they are investing in. They are enrolled in the default fund here. Even though most providers host an ethical fund, again, most people will stick to the default fund and not make any self-conscious decision to invest ethically. Although there is an ethical fund, there is no apparent reasoning for considering some companies more ethical than another. If you see the list on the left, you've got Microsoft, Apple, Amazon, Alphabet, Facebook, Johnson & Johnson. The list on the right is the ethical fund. And the only one that survived, I think, is MasterCard was introduced. Apple is the only one that survived that list. Amazon, Alphabet, Facebook, Johnson & Johnson have been taken away from the list as if they were deemed unethical. JP Morgan Chase was also removed. If anyone in the audience banks with JP Morgan or works for them, maybe you'd like to find out why this pension fund decided that you weren't ethical enough for their ethical fund. Nestle and Visa were also removed from this ethical fund without any apparent cause or reasoning. Shouldn't they be given the right to defend their ethos, essentially? Interestingly, though, if you notice my next slide, the default fund since launch had an annualized total return of 9%, while the ethical fund had an annualized return of 10.9%. Does this mean that the pension provider is acting unethically itself if it doesn't do anything to communicate to investors that there are better options out there, financially and ethically? I want us to apply this new way of thinking and challenge the status quo. We need to challenge the way we think about ethics. Constant inaction and a lack of self-challenge time and again only leads to unethical behavior, and it never once has worked out, well, in the long term anyway. Regulation is not the only solution. The 1933 Glass-Steagall Act lasted for 66 years. Sorry, that's a typo. It's supposed to say 66. It was 37 pages long, and its sole goal was to separate Wall Street from the banking sector, and it worked. And in 1999, the Financial Services Modernization Act essentially removed the power of Glass-Steagall, and what followed was volatility in the market and a crash in 2008. The US Bill of Rights, that most influential and long-standing of modern constitutional documents, is only 1 page long and is still going strong. It fits on one A4 page piece of paper. We also have the 10 Commandments. This is barely a paragraph, yet has guided human ethics for centuries. In contrast, the more recent Dodd-Frank Act has far, far too many regulations for any one legal department to comprehend, yet alone abide by. It'd be like trying to follow the Bible exactly as it is written. I want to kind of take a new approach to ethics. We must empower financial sector employees to think critically about their ethics instead of limiting their thinking by a set of rules. I want to give analysts, they should be informed of relevant issues, making their information easy to understand. Enable companies, give executives the impetus to succeed at being ethical. I want to give minimum scores so that external parties have the right to affect the score if they can justify the means to do so. There should be industry comparisons across all countries so we can assess progress using comparative information. And I want to make it available so that it's accessible by anyone via the internet for a small price. It should also detail how the rating was formed and what it is based against. Further to that, we could have ratings on social behavior and environmentalism, how an entity behaves in an environment in which it operates, For instance, they can score points by tracking the levels of carbon they emit or sequester, how the entity behaves socially. Entities can score points by investing in local enterprise or education, sport, and culture. The transparency of the supply chain. A company score can and should be affected by who they supply or who their suppliers are and their suppliers' scores. This can work both ways. You can have a positive or a negative score based on who your supplier is. There should also be ventures on significant positive initiatives. Even more points can go for introducing or researching ideas that haven't been thought of or achieved before. And I hope you get the general point of what I'm trying to get at. What I want you to take away from this today is there is a higher purpose to this issue and why we're talking about ethics more and more. It's not easy to identify and understand in the context of today's economy, but I hope my agenda will reinforce the voice of today's young by highlighting the desire for an ethical future in finance. That's it. Thanks very much for having us.
Thank you so much, Colin. We've got a tiny bit of time left on the clock. I wonder, do we have any questions from the audience? That was obviously some great in-depth commentary there from one of our nominees. Any questions from the audience? We have a team of especially trained athletes ready to run for the nearest question. But I think we're good. Okay, once more, a round of applause for Colin. That was great. Thank you. Thank you very much. Brilliant. Okay, moving on to our next nominee. She is a PhD candidate at the Polish Academy of Sciences. Ladies and gentlemen, please give a huge, very warm round of applause to Monika Święcena-Próźnik.
Right. Good afternoon, ladies and gentlemen. I appreciate that this is almost the last session of the entire conference. I understand the networking is more valuable than participating in panel presentations, so I appreciate that so many of you did come to listen to us. As already been mentioned, I'm currently pursuing my PhD degree in European Banking Union regulations, and during the course of my research, I have been studying the causes of the recent financial crisis and the root causes of it and possible consequences for the banking sector and what can be improved to not to facilitate and to avoid any future financial crisis. During the course of my research, I have came upon the concept and the idea and basically the problem if banks and if the financial sector is actually ethical. According to the Conduct Cost Project Research Foundation, between years 2012 and 2016, 20 largest banks globally that employ 2.3 million people and operate on a global level, that is population of 2.3 million people is the population of Lithuania, have actually been forced to pay fines for misconduct, redress, and mediation activities that equaled 300 billion Great British pounds, that equals 70% of the Polish GDP. So that is quite a significant amount, to be honest. To understand the root causes of such huge apparently problem and the causes and the scope of the last financial crisis, I started to ask the question, if this behavior is driven by individuals, or is this a problem sector-wide, or is this an organizational problem? Contrary to popular opinion, things that you see on the media, famous cases of prosecutions on individual fraudulent activities by bank employees, it's only 6% of cases of misconduct-related cases that were caused by individual wrongdoing. 85% of all cases related to misconduct were a result of mis-selling and mistreating customers. That proves that this problem is actually not an individual one, but it has its roots in how banks are organized. However, it's not only the problem of the banking sector per se. This is a problem of the entire economy, and not only of one country, but of the entire world. Around the world, in the years of 2012 and 2016, 50 million people were detrimented and impacted by the misconduct cases. Only in the UK, the 13 million people were detrimented in the PPI scandal alone. in order to understand what is the impact of this behavior on banks alone, one have to reach to the analysis and to the statistics. In the previously mentioned CCPRF Foundation report, it states that 10% of all costs incurred by banks in the given time were a result of misconduct behavior, and if the banks were not forced to pay those fines or costs of remediation and redress activities, their return of equity would be 3% point higher, and the profits there would have been 21% higher than they actually were. This does not include the reputational cost that is harder to measure, but according to Oxford Analytics, this might even equal to 9 times of this cost in lost income due to reputational reasons. One would argue that in current economy that is transparent and investors are smart and they take care of each other, the market would be able to value the ethics and the good conduct in financial institutions. However, the above-mentioned statistics and the research that I have conducted shows that this is not true. Unfortunately, markets and investors are prone to so-called short-termism, i.e. the instant gratification, and also something that my colleague previously mentioned. They prefer instant results, higher dividends, without thinking about the strategic and long-term results that, as it has already been proven on many occasions, ethical banks prove to be more profitable in the long term. There is no, as it's already been mentioned, there is no single definition of what exactly conduct and ethics is. So in order to measure it in the banking and the financial sector alone, we have to take some approximation. In the UK, for a couple of years now, the Banking Standards Board has introduced a survey during which it questions and conducts interviews within the bank's employees and management boards and senior managers to understand what is the level of ethical behavior and what is the level of ethics and good conduct in this bank. However, the problem with this survey is that it's not legally binding and it's not being publicly disclosed. Therefore, it's only been circulated internally within the banks, within every single bank alone. So there is actually no external force that could force banks to implement new policies and new practices. Going from that, I argue that as I've already mentioned, markets cannot value the good ethics. The Banking Standard Board survey is not legally binding. There is a need of external regulatory intervention. The intervention could go both ways. It could be either positive, in a way of some kind of a stimulus, or a negative in form of the bank tax or levy that would be detrimental. However, the behavioral economics proves that people react better to positive stimulants, and that gives them something to pursue, not something to be afraid of. But for this positive stimulus to be efficient, it needs to be targeted as a specific group of stakeholders within the banking sector. Within the banking sector, we've got a couple of groups of relevant stakeholders. We start with the shareholders that exercise pressure on management boards to get higher dividends and higher profits. The management board thus introduces policies and procedures that have to be followed by the managers and workers and employees by the banks. That affects how the clients are being treated and what is the level of the customer service. Therefore, as on top of this chain are shareholders, my suggestion is that we should focus this regulatory stimulus on this particular group of stakeholders. For shareholders, the most important factor is the return of equity that we could divide into, that comprises of two parts. We've got net income that comprises of revenues, costs, loan impairment charges, corporate tax, and in some countries there's also a specific bank tax. And the second part is the capital that is being a responsibility of the regulator and the supervisor in any given country. And this is the part I think that would be most efficient, because this could prove that whenever banks have are being forced to hold more capital or less capital, this acts as this positive stimulus. Otherwise, everything on the top of this slide acts as a negative. Bank tax, corporate tax, and any given costs resulting from fines or some court legal rulings. However, in the light of the recent regulatory tsunami of the Basel II, III Capital Requirements Directive, people argue that banks are already encumbered heavily with the regulatory requirements. However, according to the research and to the data of Bank of International Settlements, Bank of England, International Monetary Funds, for average 30% that is already required for an average bank in any given country, and additionally 18% for the largest global banks, there's still something that gives room for improvement, but for the banks to still maintain the profitability. According to the IMF, capital requirements could be raised up to 18%, to Bank of England to the 19%, and to the Bank of International Settlements, there's still room for improvement, and there could be 20% capital requirements for all banks, but they could still be profitable. So to sum up, what I suggest to introduce is the regulatory stimulus that would be measuring the conduct and would be encouraging the good behavior and ethics in the banking sector. That would be, for every single bank in the given economy, an additional 1% of risk-weighted assets regulatory requirement. And based on the Banking Standards Board survey, but this one would be conducted on a biannual basis, and that would also include customers, not only employees and management board, but also customers, that would be conducted by the regulator and would be publicly disclosed. The regulator would be then dividing banks into 3 groups: ethical banks, normal banks, and non-ethical banks. And for the ethical banks, the regulatory requirement would be put down to 0, and for the non-ethical banks, the regulatory requirement would stay at this 1% of risk-weighted assets. Almost on time. Thank you very much. If anyone has any questions, I am available after the presentation. Thank you.
Fantastic. Thank you, Monica. That was wonderful. Used your time just to perfection. That was brilliant. So a very high standard from all of our nominees today. Speaking of which, we are going to move on to our final of our 3 nominees now. He is a PhD student from the University of Navarra in Pamplona, Spain. Please welcome to the stage Andrea Roncella.
Good afternoon, everyone. Thanks for being here. So the idea behind this paper came to my mind when I was reading the inaugural speech of the Schwarzman College of Computing, here on the picture. That is the MIT New Artificial Intelligence Hub, where the president of the prestigious university claimed that the world needs bilinguals. That means engineers with better education in the liberal arts, able to build ethical products and platforms in order to develop responsible innovations. For this reason, the MIT set up an interdisciplinary faculty that researches and teaches disciplines ranging from the STEM subjects to the social sciences and humanities. A similar concern that nowadays is unresolved, to me, characterizes the financial innovation process. As a consequence of the 2008 financial crisis, we can say that there has been a special effort to include business ethics courses in the business schools, in the curricula of School of Economics, of Management, of Finance, and that, of course, is a very good news. However, this article asks whether the current debate on finance and ethics is missing a key point. The world of financial innovation is largely underpinned by technological innovation, as expressed by conferences and events like this one, on one side, and on the other by the widespread of new roles, such as the quants, the financial engineers. So while the technical knowledge is obviously central to the educational process of the people who will fulfill these roles, our article highlights the need for a kind of education that takes into account a humanistic component in order to stress and to integrate the non-quantitative dimension of finance, of its products, and of its institution. The statistics we collected suggest that an increasing number of students with technical background are turning their attention to professional careers in finance, usually making this transition through an academic experience such as a master's degree in financial engineering. Now, the interesting thing is that we underline in our research is that the curriculum of some of the best universities in financial engineering offer courses that are very highly specialized and apply mathematical and physical science models to disciplines such as financial risk management, financial modeling, derivatives structuring. Among them, however, only the MIT and the Imperial College of London offer a business ethics course. In contrast, if we take a more classical path toward the financial industry, as an MBA, it's possible to see how nowadays the best MBAs in the world all offer business ethics courses, and almost 70% of them are actually mandatory. So the current situation, I think, can be well coached by the words of these popular business ethics scholars, who says that financiers and traders are subject to ethics oversight and professional code of conduct, while the quants, and I could say the financial engineers, are left to operate in relative ethics vacuum. This is due to me to two main reasons. One is the technological advancement, and the second one is the mathematization of economics. In particular, the mathematization of economics, I think, is the most problematic. Since the 19th century, actually, the economics as a science has been featured by the principle of non-overlapping magisteria, the NOMA principle, which establishes that economy is a free values subject. Of course, if you think that this principle actually features economics, you can understand that the same idea held true for finance and even more for financial engineering. Conversely, this article claims that there is no technical analysis that should be devoid of ethical considerations. To support our suggestion, we take advantage of an anecdote that happened to the great Russian nuclear physician, that is Andrei Sakharov. During the Cold War, Sakharov was really plagued by the images of 2 deaths due to a nuclear experiment, and expressed the hope that Russian weapons would never explode on cities. The high official, the military, who ran the experiments, replied that the task of scientists was to improve the weapons. How they would be used was not their concern. Sakharov replied to this, saying that this is not possible to deny the existence of a common human faculty by someone called as conscience that allows one to acknowledge what concerns human beings and which takes precedence before any kind of specialization. So the history of Sakharov and the official is enlightening, since it underlines the moral responsibility that also financial engineers and quants, as technicians, they do have. So the detachment between the moral responsibility of a technician and the technical specialization can become even more problematic if we consider that there is a risk that the composition and the structures of the networks behind this financial innovation may suffer a risk of abstract knowledge, also called reification. By reification, we mean that the facts, the real world, is actually secondary to theory, and if there is a discrepancy between theory and reality, it is reality that should step aside. And we think this idea is well caught by the words of one of the most famous and popular quants, Paul Wilmot. The reason behind this problem is, on one side, the lack of openness in the innovation processes, because these innovation processes usually happen within private financial institutions, and university and research centers are usually oblivious to them. And on the other side, the homogeneity of the actors involved. Usually the authors who stress these kind of problems underline the role, the supposed role that the university should play towards creating a more integral financial innovations. However, this proposal to me clashes with the reductionism that actually features the university curricula of financial engineering, as we have shown before. The idea that we try to propose in this article is that is the result of an original mixture, I would say, of positive psychology and virtue ethics. Virtue ethics is a stream of ethics that is drawn in particular upon the insight of Aristotle, and in particular with regard to the practical wisdom. According to Aristotle, practical wisdom is the virtue of choosing the right means to the right ends. Along this line, we propose, first of all, to rethink the education of a financial engineer by identifying those moments in the decision-making process where ethical issues can actually emerge. And this could be done through the use of role models, whose example can stimulate student aspirations. A real case that could work for our aim is, for example, that of Markopoulos, the quant who first unveiled Bernard Madoff's Ponzi scheme. His case is very remarkable to underline both his quantitative knowledge as a financial mathematician and these epistemic virtues of courage, in particular, to ask questions where others kept silence. So to summarize, in this article, we firstly wanted to take stock of the problem behind financial engineering education, underlying the philosophical and practical reasons why it is urgent to delve into the moral character of quants and financial engineers. Secondly, we try to briefly sketch some ideas that can hopefully contribute to define a future framework. First of all, to rethink the financial engineering education through the lens of virtue ethics, in particular leveraging the practical wisdom. Second, to involve more universities and academic research in the process of financial innovation. And third, to adopt best practices and standards of conduct, for example, taking advantage of role models. The hope is that just like physics or neuroscientists, men and women involved in financial innovation could become bilinguals too. Thank you very much for your attention, and I'm available for any question. Thanks.
Wonderful. Grazie mille, Andrea. Wonderful. Great presentation. So I would just like to invite all of you to give a very warm round of applause to our three brilliant nominees who joined us today on the Spotlight stage. That was absolutely wonderful. Thank you so much. And could I also invite our three nominees to come and join me on the stage, where we're just going to have a little group photograph while we're all here. While they're gathering on the stage, let's saunter over here and see what our brilliant scribes have come up with over the past hour. So here we have a slide all about digital financial inclusion, technology changing the equation for the unbanked, transforming access, about interface design, the new challenges, digital currency, fighting financial crime, evaluating risk. We need a new financial ecosystem. Absolutely brilliant. Then we moved on to our ethics and trust section, which is we had a bit earlier. and we need a different kind of training. Business schools have become too abstract. Andrea's presentation there, too focused on technical skills. Economics have become too mathematical. Moving on to Monica's presentation, all about regulatory stimulus and where to focus, moving away from short-termism and looking at individuals or organization and figures that point towards the banks themselves. And finally, we have, first we had Colin's presentation, all about challenging our own motives. Ethics are good, but what does that mean? It's about ethical investment funds, but how to decide which companies are included and how much do investors know about their criteria. So absolutely brilliant. Please do come and join us for a selfie moment, a congratulatory moment for our brilliant nominees on stage. Thank you all so much for your excellent presentations. I'm going to actually take a photograph here myself, and I shall be sharing this on LinkedIn. Oh yeah, sorry, we've got a nicer slide up behind you, so we have to do that again, if you don't mind. Wonderful. So yes, absolutely take a bow. That was brilliant. I think it's going to be a fantastic session in Paris, and you know, that was very, very thought-provoking. I am looking forward to the updated version of this for the 7th edition. Now, for the purposes of commemorating the moment, using photographs, could I please invite our strategic partners and members of the Swift Institute to join our 3 brilliant nominees on stage, Paul Dembinski, Martin Gregson, Virgile Perret, Peter Ware, of course, your good self. If you could all join the nominees on stage, we'll do some more. And Nancy, of course, thank you so much. If you could join our nominees on stage. Just to remind you, the finalists have not been selected. That will all be announced at the OECD. And wonderful, and good luck. I hope it's a fantastic event. I think it's going to be a very, very inspiring new edition of this book. Okay, 3, 2, 1. Oh, okay, a bit of movement there. Yes, nice. Okay, perfect. Excellent. That's even better. I can move closer. Thank you all so much. Great. Okay, congratulations all. Once more, a big round of applause for all of our nominees and our strategic partners. Thank you. We're coming back here at 2:30 for Julia Hobsbawm, OBE, and we're going to have a whole afternoon about tech-related topics under the umbrella of Banking for a Better World. Thank you.